guys, Carrie from Carrie Buys Houses. Today we're going to be talking about the fifth part of our series on how to get started in investing without a lot of money out of your pocket. So we talked about SCOPE the other day. SCOPE stands for Seller Financing, Cash, Options. P we're going to be talking about today, and E is existing financing. So I brought my good friend and mentor back on our show today. This is Augie Bylat. Thanks for coming out.
Glad to be here, Carrie, always.
So what does the P in SCOPE stand for?
It actually stands for private lending or private money. And this is where we work with individuals. So it's private lending, and this is a loan, like you could be my private lender or I could be your private lender as an example.
Okay.
So that's really what the P stands for.
Okay, now what do we use private lending for?
Well, we look at it from this perspective. You know, people are looking to make a profit, right? So the next P in our little process here is profit. And what we do as investors is we are able to share some of our profits with private lenders in the form of interest.
Okay.
Okay, so they help move our business forward by providing capital. So the reward they get for providing that capital is going to be interest on the money that they provide.
Okay. Now what is the purpose of using private lending?
Well, the primary purposes behind private lending should be one of two things. And this is important for you investors out there to understand, because money that comes from a private lender should only be used for one of two purposes. It should be used for property purchases or acquisition, okay, or for repairs. There's a lot of different ways we can buy properties. We've talked about a number of them. So sometimes we don't need 100% of the purchase price and repair money. Sometimes we can just use money from somebody to do the repairs. But the key to understand if you want to be a successful investor is that the only things you're going to use private money for is either purchasing or repairing properties. This is not intended to be operating capital. You do not want to consume this capital to buy groceries, pay rent, pay your cell phone bill, or put gas in your tank. That is not what it's for. Both of these will add value to an investment. That value allows you to create a profit, which you're going to share in the form of interest. So I just kind of put that little proviso out there as a warning. It's a red flag. If you see yourself needing money, don't go to a private lender. Go do another deal, flip a contract, do a whole bunch of different things, but don't consume somebody else's capital, because that could also make you guilty of fraud, because you're going to have some documents that protect the lender in this kind of a deal.
Right.
But let's continue with your question. So the purpose is going to be to purchase or to repair.
Okay, so what kind of people are we dealing with when it comes to private lending and sharing our profits with interest?
Okay, we're dealing with pretty much anybody that is either in our circle or enters our circle. So private lenders can be family members. They can be people that you went to school with. They can be people at church. They can be people that you might work with if you work a regular job and do real estate part-time. One of my students and one of your peers in our mastermind program, he was an on-the-road sales guy, did part-time investing until he had enough houses to retire. So when he would meet and take his clients out to lunch, he'd not just talk about his core business, he would talk about his real estate business and how he was working with other individuals, helping them get great returns on their investment capital. And he did this over a couple of year period, and little by little the seeds would start to germinate. And now he's got access to about $2 million worth of private money.
That's great. You can buy a lot of houses.
From his now former clients, because he has since acquired enough houses, he's got enough passive income, that he's now left the business world of his old job, and now he's just a full-time real estate investor.
Right.
With access to tremendous amounts of capital.
Right.
And that came from a lot of his clients. So the other interesting thing is, it's not just, people say, well, gee, I don't have a lot of money in my checking account. That's okay, because there are people out there that have 401k plans. There are people out there that have IRAs, individual retirement accounts. And through the power of what's called self-direction, we can actually help people work with IRA administrators or 401k plan administrators that can actually allow you to invest your retirement assets in private loans.
Right.
So that's kind of a powerful tool. And I know, I've done it sometimes myself, because it just gets me a great, safe, profitable kind of return.
Right. I think there's so many people out there that have some kind of capital somewhere and they want to get better returns. I even know of people who had HELOCs on their house and they wanted to put it to use.
Yeah, a home equity line of credit. That's a HELOC for anybody that might not be familiar with that term.
Great. So how is everyone protected in the deal when we're dealing with private lending?
Yeah, that's a great question. You know, I would want to know, how would I be protected if I was going to give you some money?
Yes.
Well, the first form of protection is what we call loan to value. That's LTV is the abbreviation for that. And a loan to value, the best way to describe that would be the amount of money that's in the loan divided by the actual value of the property. We tend to call that the ARV, the after repaired value. So I know that when I work with people, I keep the LTV usually at 70%, sometimes less. I never go above 80% LTV. So that's my loan to value. And what that means is, if everything went down the tubes and there was a 70% loan to value, the lender could turn around and resell that property at 80 or even 90% of its value quickly, so that they could fully recover their investment, plus interest usually. So that loan to value is an important consideration. So if somebody comes to you as a potential private lender and says, "Hey, I want to buy this house for it's worth $100,000, and would you lend me, $95,000?" My answer would be
That'd be a
no.
little risky.
That would be an imprudent loan to make. But if they came and said, "Look, I've got this deal. The house is worth $100,000. I can buy it for $50,000, and it needs $15,000 in repairs. I'd like to buy $65,000. Is that something that you might be interested in?" I would be very interested in it. I'd want to definitely, as part of my protection, I'd want to verify the value. So I might want to see some comps, a comparative market analysis. So that's another way I'm going to protect myself, because I want to know that that ARV, the after repaired value, is what the investor believes it is. Because that protects both of us. I want, if I'm the lender, I still want them to make a profit, because remember, that's where my interest is coming from, their profit. So I want to make sure we have that. So the LTV is a good starting place, loan to value. Other things that are going to help me to be protected are the fact that we're going to have some documents recorded. We're going to have a promissory note, which is an IOU. And that promissory note basically says, I'm borrowing X amount of dollars. I'm going to pay you back this way over this period of time. So it's going to either have a monthly payment, or sometimes the interest will accrue until the property is sold. But it's going to dictate that if I do what I'm supposed to do, this is what I'm going to be doing. And it also indicates, if I don't do what I'm supposed to do, what happens. So, you as the lender can take that property back. Okay. In addition to having a promissory note or an IOU, we're going to have a mortgage. And the mortgage is actually a pledge. People don't really, they always think of it, the mortgage is a loan, but it's not. What the mortgage does is it pledges that property as collateral for the loan. Okay, which says, if I don't honor my obligation under the promissory note, I've pledged the ownership of this property to you as the lender. So you can take this property back in the event I were to default. So we've got a loan to value, we've got some comps, we've got a promissory note, we've got a mortgage, but we've got a couple of other things too. One is, it's called a mortgage, it's called a title insurance policy. Okay, it's a lender's title policy, which is a little different because you're going to have an owner's policy, but the lender's policy lets the lender know that there are no liens that are superior to their situation. Okay, so, or if there are liens that are superior, because it could be a first mortgage and the private lender could be coming up with a second mortgage. But I definitely want that title insurance, because it's going to tell me nobody else has any rights or claims on this property that I'm not aware of. Okay, so title insurance is a real good value, and it helps me feel protected. The last piece is my hazard insurance policy. Okay, and my hazard policy basically says, hey, if this house burns down, I don't get stuck with a vacant lot. Okay, I'm going to be named in the policy There's something called a mortgagee clause, because you have a mortgagee and a mortgagor. The mortgagee is a lender, the mortgagor is a borrower. And so this hazard policy is going to name me or my company or whomever it is that's making the loan. It could be my IRA. So whoever the lender is going to be named in the insurance, which means if there is a claim and the claim gets paid,
Right.
then I'm going to be on that check
As the lender.
as the lender, so I may be able to control the release of those funds to re-renovate the property
Right.
based on whatever the decisions are going to be made at that time. So I'm protected a lot of different ways. I've got my loan to value, I've got an IOU, I've got a title insurance policy, I've got hazard insurance, but the biggest protection really is going to be my loan to value.
Yes.
Okay, and that's really important. I don't want to go crazy with, exotic loans to value because I can end up in trouble.
Right.
So that's kind of, I think, an overview of, private money. And it definitely differs from hard money.
Yeah, so we get this question asked a lot. What's the difference between hard money and private money? And there's a pretty big difference between the two. Now, when I first started out in real estate investing, I had to use hard money lenders because I needed to build up my portfolio and my experience, and I didn't have a network of private lenders at the time. So what is the difference between a hard money lender and a private lender?
Well, a hard money lender today tends to be a company. So it's a business that's in the business of lending money. And since the mortgage market meltdown a few years back, these hard money lenders have become much more like banks. They used to be strictly asset-based lenders, so as long as you could fog a mirror, they'd lend you 60 or 65% of the value of the property. But they also have a lot of additional costs.
Right.
Number one, they always charge points, and points, 1 point is equal to 1% of the mortgage. So if I'm buying a property for, say, $200,000,
Right.
that I'm going to fix and flip for $300,000, well, that sounds like a killer deal, but what can happen with hard money lenders is, let's say they were going to charge me 5 points.
Right, it's a lot of points.
Well,
that's 5% of 200,000.
Which is $10,000.
Correct.
Okay, and that's before
That's just the cost of the loan.
That's stepping in day one.
Right.
Okay, I now got that element.
Right.
But they also tend to have a lot of other expenses. They'll have appraisal fees. They'll have draw fees. They have management fees. They kind of can fee you to death.
Yes.
Additionally, their rates are going to typically be much higher, the 12 to 15% range.
And that makes a big difference when you're talking about a $200,000.
Yeah, if I'm borrowing money at, say, 12%, that means that on a $200,000 loan, I'm paying $2,000 a month in interest, and that's interest only, no amortization.
Right.
So it's going to be an interest only loan. So I pay 10 grand up front, which means they're going to fund me 190 minus any other fees.
Right.
And so additionally, if I'm borrowing repair funds, they might charge me an additional $125 every time they do a draw, because they're going to send somebody out to look at the property or to review the invoices that we're sending them. So it's a real kind of business-to-business kind of arrangement, and it can be quite costly.
Very.
They call it hard money, but it's really easy money because it's easy to get. But I think they call it
hard
hard money.
pay back.
Yeah, it's hard to make money after they're done.
Right.
Because if a deal,
you're sharing almost all your profit.
Well, think about it. I mean, if it takes you 6 months to get in and out of the deal at $2,000 a month, that's $12,000 in monthly interest plus $10,000 in points.
Yeah.
That's significant.
That is.
Now, with private lenders, they're typically not going to take you through that level of a ringer, if you will. Number one,
because these are people, not institutions.
Yeah, we're dealing with an individual, and if you can get them a decent percentage rate of return, then you're not likely to have to pay points. And if you do, it's probably going to be 1 or 2. It's seldom going to be 3 to 5. And your interest rates are much more negotiable.
Right.
So you've got flexibility on your rates. You've got flexibility on your terms as well, because I know I work with a number of folks who use their IRA funds or 401k funds, and these are people that are still working jobs. And so they're not even going to personally use the interest today. They're simply growing their retirement account. And so in many cases, they don't need a monthly payment.
Right.
So they provide the money when we acquire the property, and then when we sell the property, they get their capital back plus their interest in a lump.
Mhm.
So the difference between hard and private is kind of significant in terms of ease and also cost.
Right.
So, that's why I think in the scope formula, private money or private lending is a tool you definitely need.
I kind of think of hard money as like a step down from a bank. So you've got the bank, the hard money lender, and then the private lender. Obviously, private lender is going to be the best one. Hard money lender is you still have to gonna qualify for that loan. And then of course the bank, you're definitely gonna have to qualify for it.
Absolutely. And it's going to take a lot longer to get approved.
Yes.
The good thing, at least with hard money lenders, you can get approved well in advance.
Right.
And then they'll just want an appraisal on the property to make sure the value is there. So banks are going to take much longer, which is one of the reasons I don't tend to use them.
Right. So that's it, you guys, private lending. If you want to learn more about private lending or investing in real estate, Augie's got a free ebook out, which is the Financial Freedom Blueprint, and you can get that ebook by clicking on the link above the Learn More button. And where can they find you for more information?
They can find me at creatingwealthusa.com, and actually we even have a little cartoon on the very subject of private money.
That's right, the three little piggies.
It's called The Smart Investor.
It's a great video, so check that out. It's really going to clarify what private lending is.
And it's a great tool to even show your prospective private lenders.
Yeah, absolutely.
Because it brings it down to, like a child's level.
Right.
For simple understanding.
Right. And all this information is going to be up on my blog page in Carrie's Corner at Carrie Buys Houses. And of course, if you have anyone that's interested in selling a house, or you yourself is interested, you can contact me at Carrie Buys Houses. That's it for today, guys. Thanks, Augie.
Oh, thank you, Carrie.